Let me ask you something uncomfortable. When a bank asks how much you have saved, why do they want to know so badly? It sounds harmless. You're applying for a loan, a credit card, a mortgage pre-approval. They ask about income, they ask about debts, and then they ask about savings. You assume it helps you. More savings means safer borrower. Safer borrower means better terms. That's what you've been told. But here's the part most people never think about. Information changes leverage. When a bank knows how much cash you have, they don't just see stability. They see runway. They see how long you can survive without income, how long you can tolerate pressure, how desperate you might become if something shifts. And desperation changes behavior. The person with no buffer signs faster, accepts higher rates, takes the first offer. The person with margin negotiates differently. So when you reveal your cushion, you're not just proving responsibility, you're revealing your tolerance. And tolerance affects pricing. Banks don't need you broke. Broke people default. They need you tight enough to comply. Tight enough that you won't walk away. Tight enough that a delay feels dangerous. Tight enough that approval feels valuable. The more they understand your cushion, the better they can calculate your pressure. This isn't about hiding money. It's about understanding that financial data is not neutral. It's strategic. And the moment you share it, the balance of negotiation shifts. The real question isn't, do I qualify? It's, who holds leverage once they know my numbers? Savings don't just represent discipline, they represent positioning. To you, savings mean security. To a bank, savings mean data. Data about risk, data about behavior, data about how you respond under pressure. When they see a small buffer, they see urgency. Urgent people move quickly. They accept terms. They don't stall negotiations. When they see a large buffer, they see resilience. Resilient people hesitate. They compare offers. They walk away if something feels off. That difference matters. Because pricing isn't emotional. It's probabilistic. If your savings suggest you can endure months without income, you're harder to pressure. If your savings suggest you're one disruption away from stress, you're easier to close. Banks model behavior, not morality. They calculate how likely you are to refinance, how likely you are to revolve balances, how likely you are to tolerate small increases in cost. Savings help them estimate all of that. It's not about punishing you for being responsible. It's about understanding your flexibility. And flexibility is leverage. The less flexibility you have, the more predictable your decisions become. Predictable decisions are easier to price. So when you disclose your financial cushion, you're not just proving stability, you're revealing how much room you have to resist. And resistance is expensive. Leverage doesn't shout, it adjusts quietly. Once a bank understands your financial cushion, the conversation changes, even if you don't notice it. Rates aren't random. Credit limits aren't generous by accident. Offers aren't personalized out of kindness. They're calibrated. If your profile suggests you need approval badly, speed increases. The process feels urgent. Deadlines appear. Limited time incentives show up. Urgency shortens negotiation. But if your savings suggest you can wait, something different happens. The tone softens. The offers become competitive. Follow-up emails arrive, because the client who can walk away must be persuaded. Banks price risk, but they also price behavior. A person living tight is statistically more compliant. They refinance when told. They accept minor rate increases. They prioritize maintaining access. A person with margin behaves differently. They compare lenders. They delay decisions. They calculate total cost, not just monthly payment. That behavioral difference changes profitability. So leverage isn't about confrontation, it's about positioning. The less pressure you feel, the more pressure shifts away from you. And pressure determines terms. This is why savings matter beyond safety. Not because they impress institutions, but because they alter the negotiation dynamic. When you can survive without the deal has to survive without you. That's leverage. And leverage, more than income, is what reshapes the outcome. Here's the tension most people never see. Banks don't profit most from chaos. They profit from controlled dependence. If you're broke, you're risky. If you're wealthy and liquid, you're selective. The most profitable position sits in between. Stable income, some savings, ongoing obligations, tight enough to care, not tight enough to default. That's the ideal client. When you're tight, decisions feel urgent. You refinance when rates drop slightly. You accept offers that reduce monthly payments. You prioritize approval over negotiation. Not because you're irrational, because pressure changes behavior. Freedom behaves differently. When you have deep liquidity and low fixed costs, urgency disappears. You don't need the deal today. You don't need approval this week. You don't need promotional incentives to move. That slows everything down. And slower clients are harder to monetize. A person with margin asks different questions. They care about total cost, not teaser rates. They compare terms aggressively. They delay purchases without fear. Delay reduces volume, and volume is the engine. So modern finance is structured around manageability, lower monthly payments, longer timelines, flexible minimums. It keeps you comfortable. It keeps you current. It keeps you engaged. But engagement isn't the same as control. When every major asset is financed, when every upgrade extends your timeline, when every raise increases your fixed baseline, you stay active in the system. Activity is profitable. This isn't a conspiracy. It's alignment of incentives. Banks optimize for predictable repayment. Predictable repayment comes from predictable behavior. Predictable behavior comes from calibrated pressure, not crisis. Pressure. Enough obligation to keep you compliant, not enough stress to push you out. That's why being comfortable can be misleading. Comfort can mean your system is functioning smoothly. It can also mean your leverage is limited, and limited leverage keeps you negotiating from need, not from choice. Banks don't fear your savings. They fear your independence. Because independence changes the speed of your decisions, and speed is profit. At this point, it would be easy to say, stop telling banks anything. But that's not the lesson. The lesson isn't secrecy, it's positioning. Banks aren't villains. They price risk. They model behavior. They optimize leverage. The real question isn't what they know about you. It's how much control you have when they know it. If your financial life depends on constant approval, you're negotiating from need. If your lifestyle collapses without uninterrupted income, you're negotiating from pressure. And pressure always weakens leverage. The solution isn't hiding your savings. It's building enough margin that approval stops feeling urgent. Margin changes posture. When you can walk away, conversations slow down. When you can delay, offers improve. When you don't need the deal needs you. That's the shift. Most people focus on increasing income. Few focus on reducing obligation. But obligation is what creates tightness. Tightness creates urgency. Urgency reduces leverage. Freedom isn't about impressing a lender. It's about being indifferent to them. When your expenses are low relative to your buffer, when your debt doesn't dictate your choices, when your survival isn't tied to one decision, you stop negotiating for access. You start negotiating from strength. That's what banks actually respond to. Not your confidence, not your explanations, your positioning. So instead of asking, will this get me approved? Start asking, does this increase or decrease my leverage? Because the goal isn't to win against the system. It's to stop playing at a level where every move depends on permission. If this video changed the way you think, hit like and subscribe. More ideas like this are coming. See you in the next one.